Welcome to the Broken Pie Chart Podcast, episode 341. I'm your host, Eric Moore. Once again, back is Shane Skinner, trading manager at Zega Investments. Shane, what's going on?
They haven't kicked me out yet. I'm still here.
Well, day's not over yet. We'll see how this goes.
It's been a great week. We had a little bit of volatility. Market was up quite a bit this morning at the open, all-time high, and then sort of the sell-off and sideways drift into the rest of the day. But overall, as a week, again, AVGO strong. We got through the week positive. There's a lot of good things going on in this market, I think, and it's a lot of noise too. And so hopefully we'll do a good job of weaving through that and getting to what really matters here today.
So change in non-farm payrolls today. The survey said 75,000. The actual was 22. The prior was 73. It was revised higher to 79,000. So we haven't had a negative print yet on non-farm payrolls, and I think that increases the streak. It's been a long time since there's been a negative month of jobs. Manufacturing was a little bit weak, and then you look at the unemployment rate, comes in at 4.3. It was 4.2. I haven't had the time to do the math to see, rounded, because those get rounded. So was it 4.25 or was it, I'll do that another time. So let's kind of start there. And I would just say that a lot of people are making a big deal about that unemployment now is, 4.3.
4.3. Yeah.
I looked at a Bloomberg chart and then I went back. So I'm skipping all around here, Shane, in your doc. But 4.3, the long-term run of this. So we have a higher unemployment rate than we did certainly 2024, I would say, 23, and higher than 2019. We are higher than, I would say, 2000. I don't know. What is that? 2000 or 2000? This is quarterly. So maybe that was Q1 of 2000. And then you look back and you'd have to go back to 1965, 1969 for a lower unemployment rate, meaning lower than 4%. I think the reason I bring this up, this isn't to me that big of a deal yet. Now, unemployment typically
it matters when it matters, right?
It matters when it matters, but unemployment's always the last thing to go. Like you typically don't get a leading a signal far in advance of a recession that, unemployment's been moving up for a while. No, when it goes, it goes. But my point is, historically speaking, Shane, like we're not high.
No. And September is historically, for those, and I wasn't aware of this for a long time too, but like September, they call it the September surge. A lot of hiring actually goes on in September, a lot of places. And so this is a situation where I think like the narrative or a majority of people are focused on is that this is heading in a doom and gloom direction. And, maybe we were right. We should have been cutting sooner. I'd also like to say that I don't think cutting sooner, if we had been cutting interest rates faster, that would have anything to do with saving a cycle. If we were to see an issue with unemployment down the road here,
maybe housing manufacturing,
maybe. But and this is another thing. I know I don't want to get too trailed off. Let's stay on track here. In terms of employment, it seems like the narrative is a little bit doom and gloom. People are concerned here. If you, a month from now, 2 months from now, get some strong employment prints, it's going to, again, everybody's going to go, I thought that mattered. I thought that was a big deal. The market's going to be thrilled if unemployment.
Well, I thought the market was thrilled today because it said, now they're going to cut, right?
I think the market took that as that.
Until it didn't. Until it decided it was mad for some reason.
I also think that, we were up on the week overall where we closed. So just because we touched an all-time high today and then sold off from it, look, I'm not going to try to, call the top by any means. But at the end of the day, there have been plenty of times historically in the market where we'll hit an all-time high and we'll pull back from it for a little bit before we we go higher. So,
All
I
right,
don't.
counterpoint to
Yeah.
all this doom and gloom talk. Daniel Lacal had a Bloomberg chart that he posted on Twitter or X, whatever you want to call it, and he had a chart of federal government jobs, non-farm SA, and
Hmm.
then private sector jobs, non-farm SA. So breaking down public and private, and what you find is that public jobs, government jobs, are declining. They've been declining really since the end of last year. We know that the administration has been, through Doge and through different efforts, looking to reduce the federal workforce, reduce the size of government. But the private sector is hiring. Now, could you also say that those people might be leaving the public sector and going to the private sector? Sure, you could say that too, and maybe just sort of rearranging the chairs. But I think you can't look at this and say, oh, employment's falling apart when clearly private jobs, sector jobs, are still rising. It may not be
Yeah, they're
rising.
holding. Yeah.
Yeah, I mean they're rising, they're holding, but I would say that line's going up and to the right. The audience can't see it; it's going up and to the right.
It is. And what's interesting is we say that, and I mean, the last 6 to 12 months, how many times did CNBC flash, oh no, this company cutting jobs? Oh no, this company cutting jobs. And don't get me wrong, it's, people losing jobs, that's not good. We're not, sitting here cheering for that. But at the same time, it's really interesting to see how we've gone through a year of some of these companies, cutting workforce, cutting labor, and yet the overall labor market, specifically, like you said, the private sector, it's still up and to the right. It's still growing. And again, back to what I said earlier, this is where I think if you do get some surprise job reports here in the next 1 to 3 months, I don't think there's any, argument to be made that employment's falling off a cliff yet and we've got problems. And just because the federal government's jobs number of jobs that the federal government services, it's going down. That's not a bad thing, right? And this is to be expected from a conservative administration. We've seen time and time again, historically.
It's not a good thing if you work for the government, but I mean, let's go across to some different indicators, though. This is from Justin Walfers on Twitter, from the BEA, BLS, and Federal Reserve Board. Okay, quality institutions there. So, indicators used to determine whether the economy is in a recession. So, for people who don't know, the NBER, National Bureau of Economic Research, actually meets and decides when there is a recession. Sometimes you may not know that you were in a recession officially until 6 months later when they meet and they say, oh yeah, we were in a recession. But audience can't see this. So, but just to kind of look at it, the index starts at 100 and you would say, are these things rising or are they falling? And I would say that real gross domestic income, gross domestic output, gross domestic product, real consumption, real personal income, X transfers. So that's just income. It's not looking at payments from the government. Real manufacturing and trade sales. Those are all going up and to the right. Of course, they oscillate, but they are, trending higher. Non-farm payrolls, I would say it's starting to get a little bit sideways. It's not negative. Household employment, it sort of waffled a little bit, went up. I mean, these probably don't include today, so maybe that went back down. I would say, okay, that one's not as good as the other ones. And industrial production is the one that's it's not below 100. So the NBER defines a recession as a significant decline in economic activity that is spread across the economy and that lasts more than a few months. Here's the thing. If we, you look at this, Shane, and I would say, okay, some things are slowing, some things are not slowing, but it's not screaming recession.
We're trending up into the right in every single one, technically.
Well, not every single one. I mean, I just told you, household employment, non-farm payrolls, industrial production. Those
if I'm
are
looking
sideways.
Back from, sideways. But it looks like of all the indicators listed here on this chart, those are typically ones that usually run more sideways. They might have a slope of 0.1 versus a slope of 1. When you look at the real manufacturing and trade sales, real personal income, X transfers, real consumption, GDP, GDO, GDI, that all kind of runs a little bit hotter, more up and to the right. Whereas those other ones mentioned, right, more sideways, slightly higher. But no, nothing here in this chart is screaming recession. And again, I don't think, again, there's a lot of noise out there and a lot of people connecting dots that shouldn't be connected. And I think that's where we're at in this market. And I'm sure similar stuff was going on. We've talked before how maybe this is the 90s again, 95, 96. At the end of the day, there's just nothing there yet that's showing we need to.
All right, let me give the bear case though, Shane. And the bear case is if you go to econpi, econpi.com, and then they have an index, and it's the what do they call it? Medium of coordinates, and they break it down into 4 different boxes, and they break these boxes into things that are declining, that are in contraction, expansion, and recovery. So I'll message this to you, Shane. I didn't put it in our pre-show stuff here, but basically, when the medium of coordinates is to the left or higher than that line or below it, but the left side of the graph, you would say, okay, it's in decline. Now that will move to the left, to the right. It will move in and out. But what's in contraction right now? Hires, consumer sentiment. We know that. Temporary unemployment, job openings. Recovery, existing home sales, yield curve spread. Okay. Expansion quad, things like non-financial profits. Okay. Vehicle sales, retail sales, unemployment. So anyway, you look through this, and I would say the
small
soft
business
data
is expanding.
Well,
Don't
is.
we usually look at small business data, right?
Maybe.
As a leader, right?
I'm just trying to give you the bear case. Like, look, I mean, this is, when but there is a bear case out there, and you would say that employment is slowing. I would say it's not picking up steam. I don't think the unemployment rate has risen yet substantially, but I would agree. I mean, the hiring is slowing. You look at the revisions, and by the way, you'll have revisions because when these are surveys, and you have the surveys first, and then later you get the actual state data, and that's how they do the revisions. Otherwise, you'd have to wait 6 months and you'd have no data. But all right, let's move on from this. What else we got here? Let me go to gold for a second.
Oh yeah,
and
a hot one.
Yeah, I mean, so give you a good idea of. I'm just looking at this week as an interesting dichotomy between gold, yields, and the S&P. And there were days this week, where the S&P was lower and gold was higher. Gold for the week, I think, is up almost 3%. The S&P was up about, 0.63%. If I look at like 5-year treasuries, up about 0.25%. But gold on the year, and this is from Charlie Bolello on Twitter, he has it at plus 35.5. Last year was plus 26. Year before, plus 13. 0.5 and 22 minus 3.8. Like, it's had a pretty good run, even going back to like 19. The last substantial year down was 2015, minus 12, minus 27. But I don't know. I feel like, Shane, that gold, even though it's had a really good run, and my guess is central banks are buying gold, and you have these big marginal buyers that are out there. I talked to some people about the Costco effect too, the fact that they're selling the gold pieces, the mini gold bars. But I don't know. I mean, gold's gone on a run, and it's historically has some non-correlation to equities. So I don't know. Is it forgotten because everyone's like, oh, I need Bitcoin? Or is gold just, I don't know. I feel like it's been a quiet rally.
So this is I'll send this over to you if you would like. It's a chart from Bloomberg I have on my end. Foreign central banks gold holdings versus treasuries, U.S. treasuries. As of this year, for the first time since 1996, gold holdings as a percentage of foreign reserves has crossed above U.S. treasuries holdings as a percentage of foreign reserves. So I don't think I think central banks are buying gold. They definitely are.
They're buying them.
They are.
They're buying them.
And
Yeah.
it's funny because it's, I just said 1996 is the last time that happened. And I wasn't quite born then, but if I remember correctly, and this isn't a call on the equity market, but if you had shorted the equity market when you saw that happen the last time, you got ran over for 3 years straight before the actual correction came. And so I think this ties back into what you said earlier, is that like, good luck calling the top, or good luck being able, like, unemployment's going to go when it goes. And it's an interesting situation because for the longest time, I always looked at gold bugs and thought, you're nuts. Like, I get it to an extent, put a little bit of your portfolio in it, maybe, but it's really hard to argue against the fact that this has been one of the best performing assets you could hold so far year to date in 2025. My counter to that, though, is that eventually, we've seen, at least historically, eventually the run up in gold dies down, you pull back, and it's sort of just, it's back to sideways, pretty boring, not super exciting. So I'm interested to see, if you look at gold or gold futures plotted on a monthly chart, max time available, looking back to the 70s, 80s to now, we've gone almost parabolic in gold in the past couple of years. And so, for this to continue to go higher, like much higher, I feel like there's something fundamental going on at that point. But I'm wondering if the market's now all of a sudden starting to not buy the idea that the U.S. government is actually being fiscally responsible with this administration. And that's not a criticism in this administration or not. I'm not taking sides on anything, but the way bonds, yields, and gold have been behaving, it's almost as if this market doesn't really believe that the government's gonna save money.
Well, I mean, I've thought that since the 80s, and I would tell you it really hasn't mattered.
I think there's
since,
a chapter in your book about that.
Probably the case.
Yeah.
So you bring up an interesting point, and I think there's this. I mean, gold, if you look at, I don't know, from 1980 through 2000, I could pull up the numbers. Actually, well, I could do that. Oh, GLD doesn't go back that far. I'd have to pull up the continuous futures.
Yeah, you got to go futures.
Yeah. Okay, anyway. But just looking at it, I mean, it essentially didn't really go anywhere and probably was a little bit down. And it didn't do very much. I mean, its best year going back to 1971 was plus 126.5%. And then you look at it, this is, I mean, 72, 73, 74 was better. But this is the best year, I'm just looking through, probably since 2007. And, look, I mean, there's a couple strategies we have gold in, but I will tell you, and I talk to individual wealth clients all the time, and I also talk to advisors that we run strategies for. And I would say by and large, like, people aren't clamoring for a gold strategy, which is interesting to me. And when I sort of get a sense for that, maybe there's more to go on this, because this is not
People
everyone is rushed in.
Right.
Yeah.
Right. Well, I said it earlier before we hopped on here. You could make the argument, though, that it's really hard for some people to justify taking risk off in such a strong tech bull market, right? If you've been long things like Nvidia, Apple, Amazon, or the Mag 7, if you've been along the Mag 7 for the past 10 plus years, you've probably not been that, excited at the idea of liquidating some of that stuff to get into gold, because at the end of the day, gold hasn't beaten that up until this point. Now this year, I'd have to check my numbers. I can't say exactly, but I think it sounds like gold's outperformed some
It's
of the
outperforming the
magazines.
market.
Yeah.
I pretty much know the market's not up 35.5%. So
yeah. So and that's where gold seems like one of those assets, though. And this is more of a question for me than a statement. But would you say gold's one of those assets where it's like, would you rather have it when you don't need it than to need it and not have it? Would you rather have some exposure at all times? Because, there's no denying sometimes gold will just kind of float sideways for a while. And that's not something where if you see tech running and gold moving sideways, you're probably not wanting a good chunk of your portfolio in gold. So how do you decipher that?
Well, I will tell you, I had lunch with George Milling Stanley. And so for anyone who doesn't know who that is, he actually co-created well, I'm trying to make sure I get this right, but he was involved, I'll just say, in the launch of GLD with State Street. And, State Street has been a good partner of ours, and we use some of their products. But I had lunch with him, and he said that very same thing. He said, gold will be there sort of when I need it. Gold's kind of hanging around. Look, I don't think anybody's putting in portfolios like 90% gold and then 10% equities, but it's sort of had a piece. Now, it's not, by the way, for the audience, it's not on our website, or it's kind of a new strategy. But we recently launched a strategy, and the way we do things at Zega is typically we research, then we use our own money or somebody's money.
Well, yeah. Someone sacrifices themselves for the greater good to see if it works.
Well, I wouldn't put my money into it if I didn't, think it.
I would say that too.
It was valuable enough to run it live, and then sort of. So we've got an interesting one where we use options, and synthetically you can form long positions using options, and we actually do a hedge version of. We've got gold, we've got 5-year treasuries, we've got S&P. Again, don't look it forward on our website, but that's something that we're incubating right now, and it's to your point, Shane, that people don't necessarily want to sell the equities. And so, I kind of said, well, why not just have a little of each in these? And it's our version of kind of a risk parity strategy. But I mean, look, getting back to gold, I don't know. I think you bringing up the fact that central banks hold more gold than treasuries. To me, you have this big marginal buyer that's coming in. Have they already spent all the money they're going to spend? I mean, I'll let you know when I know. But I feel like it's been a very quiet. Here's why I bring this up, Shane. In the early 1990s, I went into a store, like a tech electronics store, to buy a new TV, and the sales guy has the prospectus of the Dragon Fund, Emerging Market Fund, in his back pocket, and he's telling me about it. This is a guy selling me the TV. There's nothing wrong with the guy, investing. He should invest. But my point is, no one's being like, oh, let me show you the gold prospectus, or let me tell you about gold. It's just not happening. I don't know.
It's not exciting. It's not sexy, so to speak, right? It's really not flashy. It's just gold. And like I told you earlier too on this call, or before we jumped in here, gold bugs the people who really push gold. It can sometimes come off a little crazy, right? Or they just, because the argument for gold sort of lies in that,
No, I'll just say it. A lot of them, you look at,
they're anti-central bank. They're worried.
But they're also the ones who call for an 80% crash every 3 months and have been wrong for 10 years.
And that's right, exactly. So it's like you can't take their word on necessarily what the equity market's going to do, but at the same time, you can't allow yourself to be turned off from gold, because the people who really love gold are also simultaneously screaming for the end of the world, right? And that's where I feel like there's got to be this happy medium of understanding when gold is sort of expected to perform better, and that's in high inflationary environments, stagflation. And again, also like we just said, right? When central banks are bidding any asset, I don't care what asset it is. If it's catching a bid, it's catching a bid from central banks. Like now, are they still bidding it 6 months from now? We'll know 6 months from now. But
Yeah.
it's no, and it's interesting because I have a lot of people that I know, friends, former guys I used to trade on the Schwab and TD desk with, that love oil. And gold and oil, when compared to one another, because they're commodities, right? I think there's some interesting, you could use both together to run some technical analysis, and I think you found the same
Well,
thing. Did you?
yeah. Tobias Carlisle had put something out, and I'll quote his tweet here. It says the gold oil ratio is calculated by dividing the price of an ounce of gold by the price of 1 barrel of West Texas Intermediate crude oil. And by the way, this isn't necessarily like a gold versus oil thing. It's an economic indicator. So he's saying it serves as an indicator of the global economy and market sentiment. Excluding 2020, the gold oil ratio is higher than at any other time in the last 35 years. And he goes on to say a high ratio suggests gold is expensive relative to oil, signaling what? Economic uncertainty. Investors seek gold as a safe haven from inflation, geopolitical risk, or financial crisis. Weak oil demand. Oil prices are low due to decreased global economic activity. And he goes on to say the ratios experienced significant spikes, such as in 2008, financial crisis, 2020, oil price collapse, and has also been at extreme levels in 24 and 25, suggesting major market imbalances. And you look at the chart, you take the price of one divided by the price of the other, and you would say, yeah, you look at the chart. That one's in red, Shane, on your sheet there. And
Oh yeah,
yeah,
we're elevated. I mean, we're higher than we
but
pretty
the
much
central
ever
banks
have
aren't
been.
buying oil. So is the
Right.
marginal buyer pushing gold up and this doesn't matter anymore? Or it does? And as Tobias points out, like, okay, maybe this is high at points where,
Well, I'd make the argument. Let's go ahead and let's look at when I said on that last chart, right? Since '95, central
mm-hmm.
banks have not owned or it's more gold than treasuries, right? Let's go back on this chart. It conveniently has since 1990. And if we look 94, 95, this ratio kind of topped, and then again in 99 it topped again, and then what happened from 99 to 2001? This ratio collapsed. So it's I'm not saying that the ratio collapsing means that the market's going to do well. In fact, at the time it looks like this ratio collapsed, the market did very poorly. But at the same time, it looks like it took almost 10 years of trading and essentially a 10-point range on this ratio, 15-point range on this ratio before something turned. So, yeah, there are plenty of indicators saying that maybe there's
All
some
right. So the market
concern
is
out
crashing
there,
tomorrow is what you're saying.
but
Got it.
nah, please don't quote me on that because it'll crash the day after, right?
That's right.
But
That's right.
no, it's interesting, but also I think everybody forgets too that we're not playing in 2000 land anymore. '08 changed a lot of things, and I don't want to say this time is different. I won't say it because if I do, I know I'm going to
Oh, it will
regret
be
it.
different.
It will be right, but at the same time, you know, 2025 is not 2000.
Well, sure. I mean, we've talked about that before. We'll get to that. Yeah. All right. One thing to clarify, George Milley's thing, by the way, is a great guy. I had enjoyed the heck out of talking to him for a little more than an hour. But he is the chief gold strategist at State Street. Just wanted to make sure I gave him the proper title. But very enjoyable talking to him about gold. Wealth of knowledge, as you can imagine. So, all right, let's go to this is from Riddle's Wealth. Margins continue to improve. And this gets to your point, Shane, about this isn't really the March of 2000. So 1990s, the net profit margin. So for anyone who's driving in the car and maybe they have people in the car who don't really get net profit margin, I'll just say it. So if you sell something for $100 and your profit margin is what, 10%, you make $10, then your cost of goods is $90. So profit margins going up is generally a good thing. Maybe it makes it cheaper to buy the materials, cheaper to build, you get productivity, all this stuff. 1990, Shane, the average net profit margin was 5.6%. 2000, 6.3. 2010's 8.8. 2020's 10.3. According to this chart, we are now at 11.3%. I think, Shane, you and I calculated it. What did we do that Wednesday? I think I was even higher based upon the forward estimates. I think it was like 13.9%. So maybe these are trailing, which would make sense if you're doing them by decades. So I would also tell you that the companies today, I mean, look, Meta bought Facebook, bought Instagram. Didn't Instagram, the folklore is they had 9 employees, but $1 billion in revenue. Like tech companies have higher margins. Apple's had higher margins for a while.
How do we do that? How do we build them? No, they have though. You get these firms that are essentially 5 to 20 people, and they build these massive, essentially private companies that then the big boys look at and they go, okay, we're going to take those. That's why I think you could argue Mag 7 performance and just like it's hard to bet against the big guys because they just have so much capital. If anybody comes out and threatens their business model or threatens the direction they're going in, odds are they can buy them. So, it's one of those situations where, interestingly enough, looking at this margins continue to improve chart, we peaked in 2022 at about what appears to be 13%, I think. Looks like roughly, right? And yet forward earnings expectations on most big names are the highest they've ever been. So, this seems like we've got some room to go to the upside before this comes back. And if you notice, historically, each sort of period, 90s, 2000s, 2010s, and 2020s, right? Everything prior to the 2020s, the previous high, it eventually gets tested again, at least from what we've seen here for the most part. And so, again,
So what are you saying? We should sell the market?
I'm saying there's a lot of noise out there, man. And at the end of the day, profit margins, forward expectations are showing that they expect this thing to go higher. And I feel like I'm not saying this thing's going to go higher, right? But at the same time,
we don't know what's going to happen. This is why the core thing we do, right? We buy, we hedge, we buy and buffer. If you want more info on that, shoot me an email, derek.moore@zegainvestments.com. That's derek.moore @Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments, you got to spell on your own. Sorry. All right. So, but I think the thing I would say though is, like, what about everyone who's like, oh, reversion to the mean? Reversion to what mean?
What? So right, it's all relative.
These have been going higher.
Relative. Right. And I'll make that argument because I love to play devil's advocate. Prior to 2020s, you didn't have things like zero DTE options products at the index level.
But why would that matter to company net profit margins?
For me, it's less about company net profit margins and more of the impact that index investing and systematic inflows into stuff that is index investing has. I think that the majority of people, at least my age, my 401k is probably not in individual names, right? It's probably in ETFs or mutual funds that are tracking the index. Let's be realistic. The market has become pretty normalized for people to be invested in a basket of indexes, sectors, things of that nature.
Well, yeah, I mean, this is the S&P net income margin. It's your net profit margin for every company. Like everything gets thrown into the bucket. Everyone in there.
Yep. And I think where I'm going with that comment about zero DTEs is that like the day-to-day trading and the day-to-day sort of movement of the market, we now have a product that you can hedge. Like if you need to hedge today or tomorrow or in a shorter term, right? We now have the ability to do that. We didn't have the ability to do that 20 years ago. Now, I'm not saying that this is some fail-safe, some guaranteed protection on the market. In fact, I think it could lead to the market, moving.
But this still doesn't impact profit margins. Like this go back to if a company's making what they're making, I know the argument you're making is that, okay, that maybe we see some sort of influence based upon the options. Yes, that's fair. But in the end, you have revenue, you have expenses, and you have your net profit margin. Like that's what you have. And the fact is, this has been rising decade to decade. And I think it's obviously the composition of the companies.
Yep. So then let me ask you this. I'll pose you a separate question. We'll get away from the index stuff. Do you think that a majority of this forward expectations relies on whether AI actually produces profits and becomes actually profitable for a company to invest in? Because if I'm a company and say I invest 100 million into AI and then I'm only getting 20 million out of it return, that's not a winning investment, right? And so,
but I don't even know if you need to. I make the correlation between, like, imagine you're a company and you're not using Excel, you're not using Exchange email, and you're like, oh, okay, let's get everybody a subscription that's what, $50, $60, whatever the heck it is, a year.
Everything asks me to subscribe at this point. Everything.
Yeah, but I mean, that would increase productivity. So to me, a company doesn't necessarily need to spend hundreds of millions of dollars to do AI when they can just look at some functions and they can use the available tools that are already available. You know what I mean?
Do you think that makes the argument that
I do. I think it is in the earnings estimates. I think for sure it is.
Okay.
And I think it should be.
Absolutely right. And where this also, I think, you and I talked about a week or two ago, equal weight versus weighted on the indexes, right? And equal weight's not been doing terrible this year, right? Like I don't have the official numbers in front of me, but that's something where I also think, if bonds continue to go down, yields continue to go up, what else are you going to put your money in, right?
Well, and I'll tell you how it's been doing year to date. So please. You asked about the equal weight. The equal weight is up 8.36%. And the S&P is up 11.42.
That's not bad for equal weight in given recent years. That's not bad.
But let's look at it from the April low. So this is totally arbitrary, but I don't know what the answer is going to be. The equal weight is up 21.24%. The S&P is up 29.08 since the low, which is natural because you would think the high beta names probably sold off. What gets interesting, though, is you start to look. Let's look since August 1st. Totally random. I didn't look this up ahead of time. Okay, equal weight's plus 3.67. The S&P is up 4.41. Like that's fairly narrow. And if you look at the history of major technological advances, you would say that accretes down to the companies, the non-tech companies. Like you have old line companies that can use this technology. The other thing, though, and we've touched on this before. I think Mike and I touched on it last week. Is you have these new entrants into the S&P 500. James Seifert had a tweet, and he said, what are some of the largest names eligible for the S&P 500 inclusion today? And you might remember Walgreens went private, and Interactive Brokers got the nod. Interactive Brokers is not number one on this list, but here's some of the names. App11, MicroStrategy, Robinhood, CRH, PLC, Carvana. Let me see. Reddit is in there, not necessarily in any order. LPL Financial. You've got Roblox. No, because their prior 12-month net income is negative. Cloudflare, Snowflake. Nope, because they have negative income. So anyway, I mean, when you have these companies, and look, they could be highly valued by the time they get into the S&P. They might have gotten all their value getting to the point where they're being considered. But anyway, I think it's, to wrap this up, Shane, before we go down any number of tangents, I think net margin percent has been rising decade to decade. The number of the companies and the types of companies that make up the index, and the biggest weighted companies are more technology, and they tend to have higher margins.
Right.
And then the other thing, and then the other thing I would just say is, like, a lot of people who say that there's no way that these margins could last. I mean, look, I don't know what's going to happen, but they do this reversion to the mean. Like, it's just a different index than it was in the 70s and 80s and even 90s. Like, to try and say, or 2000, to try and say that it's got to revert to the mean.
Well, no, I agree. And you showed me this chart of AVGO with, because AVGO had a huge pop this week, right?
Yeah.
I mean, straight up to 350, and I think we closed down near 335, roughly, give or take.
Roughly, yeah.
Yeah. But okay, it's funny you mentioned all that, because you've expressed to me your belief in that, like, forward earnings expectations.
That's what matter.
Are what matter, right? Yep. And so you look at somebody like AVGO, who kind of a sweeper, although, hey, Drunken Miller took a big stake in them, from what I understand, recently, right? So it's not like nobodies are just buying AVGO. Some big names are in there, right? But sure enough, what happened after this earnings report to AVGO's PE ratio, forward PE ratio, forward earnings per share expectation, to shot straight up, according to at least what we see here, right? So it's one of those things where, again, doom and gloom, gold versus index, this or that, single name index. At the end of the day, forward earnings seem to be what drive where individual names and markets in general go.
Yeah, you look at AVGO, which is Broadcom, which I'll remind the audience. I probably said
the whole
this 8 million
equity
times.
And the ticker thing.
They did the merger between and whatever reason they didn't get the ticker for Broadcom, so it is not in the Mag 7. The Mag 7 is Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. So I would agree that it's sort of the forgotten one. It is when you look at the earnings, to your point, this is the highest forward estimate on an EPS, on an earnings per share basis, that we've seen for this company. And when it sold off in April, the earnings estimates actually were going up. What happened was it was a multiple re-rating. So what people were willing to pay for the forward estimate when price goes down, but the earnings, when this company's been going down, it's actually been a re-rating. I would say is the forward PE ratio
forward
low?
PE
No.
Forward EPS has gone higher, right? Consistently throughout this whole time, you've had more pullbacks in forward PE than you have EPS, but EPS just keeps growing, right?
And there's times when it gets extended. If you're eyeballing this, Shane, I'll look at into early 2025. The red line's over the white line for those of you at home. Forward PE over the
anytime the red line drops below the white line, though, it seems like it's been a buy. Is that safe to say? I mean,
I don't know about that, but I mean,
it's
not cheap. It's not cheap, but then you look at the spike in the forward estimates, and I would say maybe the market, the market's smarter than everybody, and it makes. But my point about a lot of people use trailing EPS. And that's fine, but that's what happened the last 4 quarters. Like, stocks trade on the expectations for the future. And it's one
Do
of the
you
reasons why
drive
the
looking down your rear view mirror
yeah,
24/7, or do you drive looking,
you look,
occasionally you glance at that rear
but
view,
that's why the market's
you got to keep
changing.
your eyes forward.
I mean, it turns normally before the end of a recession. Like the
Yeah,
market,
absolutely.
just thinking about the S&P 500, by the way, it also has a new high in forward 12-month EPS. So it's no surprise that we're around all-time highs. Is the forward multiple low? Not necessarily. It's 22 and a half, 23-ish.
It's relative, no?
I mean, look, so here's the thing. You want the bear case on this. The bear case is you would say that for this to really expand, you would have to have a higher increase in the earnings per share estimates and earnings per share actual. Because you would say, okay, if it's at 15, well, yeah, we can get to a 20 multiple. Does it go from a 23 multiple to a 30 multiple? All right, maybe. But that's the thing. You're not low, you're not
No,
early on the multiple, but
no.
that's why we buy and hedge. We don't have to think about this. It's like
Right.
good
Well,
luck trying to pick the market.
I look at this chart, right, of the index and the forward expected earnings and everything, and all I can think to myself here is the pain trade sideways into the next 2-3 months. I
think it'd be great to go sideways.
Wouldn't it be fantastic if this market could stay between 6,200 and 6,600, right? You're essentially flat to positive on the year in that range. Okay. And where we're at right now, where we open today, it's 10%, give or take, from the open on the year. So if you want to play that game of, hey, how much does the market move up annually on average? 10%, give or take. Well, we're about where that is right now. So, if this market were to pull back a little bit, I'm sure there's going to be plenty of noise. It's the end of the world. It's this and that. At the end of the day, we're right where we sort of on an annual rate looking back years now, we're right sort of where we should expect to be by the end of the year at least, right?
Just happen to take 17 lefts to make 3 rights,
And
thinking about the April.
And look, I've said it before. I talked about the book, the Misbehavior of Markets by Benoit Mandelbrot, and he says, markets don't move in a one slope up and down or negative slope up and down. Markets move in stair steps. They go straight up and to the right, or straight down to the left or to the right.
To the right, yes.
To the left. We don't go to the left, but that's sort of where I think we're at right now, where we made our move. We had that big pullback in April. We recovered. We're holding now. And, if this market were to run sideways for the next 2 months, 3 months into the next earnings season, I wouldn't be surprised. And I also don't think anybody should look at that as bad, right? Because
what would be nice, though, is if earnings expectations continue to go higher, but if price sort of trended a little sideways for a while.
Yeah,
what
creates
that means
a buying opportunity,
Well, I don't know about that, but I'm saying the forward multiple would actually contract a little bit, but the price would stay the same because the earnings go up. Remember, it's the forward estimate times the PE gets you the price. So, right now, if earnings estimates would double and the PE would go from a 22 to an 11, that's my point. Like the multiple would actually contract. All right, let's go to interest rates. So interest rates, this was a little bit of bad news is good news. I don't know. I'm so tired of this argument, but we'll do it anyway. So after the jobs number, we are assured, well, I shouldn't say assured, based upon the probabilities, we're getting a rate cut in September. That's what the Fed funds futures are telling us. We'll see whether that happens or not, although I would say that the Fed is pretty much guided in line with what the futures say, at least in the near meeting. And then October, about a 74% chance that there'll be another cut in October. December, that's when 100% probability now, 2 cuts, 89% probability or so of, let's see, a little bit more. Anyway, 3 cuts by January, 4 cuts by next April, 5 cuts by next July. That's what's priced in. 6 cuts by, and if we actually did the January cut, that would bring us down to an implied rate of 3.5. If I was running the Fed, that's where I would put it. And getting on interest rates too, you might remember, Shane, that everyone was like, yields are running away, they're running higher. This is because the deficit, well, the 10-year Treasury closed at about 4.089% yield. That is the lowest close going back to April, when we went back down towards 4%. So yields are actually going lower, not higher.
Yeah. Then the move lower was great. And as someone who just who's in the process of buying a house, my thought is, if the back end wants to continue to go down, that's fine with me. I'll refinance in a bit. If it doesn't, well, I got in where I needed to get in. So it's we're in an interesting spot here, to say the least.
Well, interest rates, the 10-year is what you want to watch. That's most correlated to the 30-year, mortgage rate. And the spread is still pretty wide between the 30-year mortgage and the 10-year.
Yeah.
If you do here I go, doing a little reversion to the mean. I just said not to do it. But if the average the long run average that I calculated based upon whatever period I pulled was about 170 basis points, typically is the spread between the 10-year Treasury and the 30-year mortgage. So 170 bips on this gets you to, 5.79% would be the interest rate. And what are we today? 30-year. Let me see. Let me go to the Federal Reserve Bank, St. Louis. 6.5. So
yep. I'll take the 1%. I'll take it.
Yeah, I mean, we're 250 basis points.
Yeah.
And
well, and let's be realistic. So I know and this is out of left field here, but I know job quits for construction I should specify real estate, sort of plummeted this week, and that caused some concern. But realistically, what I think that is, and again, I think this is just the start of this trend. You're going to see, with the deportations, again, with the policy and decision making of this administration, you might see certain areas take hits in employment levels. But he came out and said this past week, he being President Trump, that he wants Apple and other places to pull manufacturing, pull exporting jobs from places like India and bring them back to America and stuff. And so what I think a lot of people fail to understand, and unfortunately, big adjustments like that, when we're so used to exporting labor or services like that to foreign countries, it's probably cheaper to do it than bringing it home. At the end of the day, something like what he's trying to do right now takes a long time. It doesn't take weeks. It doesn't take months. It takes years. And so I think this market and our economy and just where we're at in general is in this space where, as long as we can keep ourselves held up, in the next coming years, there's a good chance that some manufacturing and some work might be coming back to the U.S. that prior to now was exported. And there goes your issue with, hey, people who are working for the government are being laid off. Well, guess what? If we can bring some manufacturing jobs and other work elsewhere that's been exported, maybe this isn't as doom and gloom as everybody thinks.
There you go. Government bureaucrats will build iPhones.
Thank you.
All right. Any recommendations for the week?
I started Formula One racing. I told you my son and I watched our first race last Sunday morning.
Yep, that's smart. Yep.
I mean, just it's so much better. No offense to any listeners that will like NASCAR, but Formula One is just it's a little bit better than NASCAR.
Well, look, we have a lot of European listeners and foreign
It's
listeners.
fantastic.
And Formula One is way more popular.
So entertaining. It just, to me, the skill. Look, NASCAR, 500 laps in a big circle. Yeah, that's just an excuse to go drink beer and watch people drive in a circle for 500 laps, right? That's the American version of racing. And realistically, I love Formula One. Don't get me wrong, I'm watching soccer too, right? And I'm excited at the fact that
our listeners would take exception.
Yeah.
You call that football.
Football. You're right. You're right. It's not soccer. It's football. But look, we have an administration that seems to be pretty pro football. So, that
we got the World Cup coming.
I know. I was so thrilled to see that announcement. And so I think it's been long overdue that the United States get involved in that space. So I'm excited for that. In terms of outside of a racing, I guess, and sports in general, I am still reading through. This is a book that I continuously read along with the Stoic book that I mentioned last time, but Zen Mind, Beginner's Mind by Shunryu Suzuki. And I might have botched that first part, but it's a fantastic book on understanding that, look, no matter what process it is that you're taking on or what you're trying to do at the end of the day, approach it simplistically. Don't overcomplicate things and just relax, take your time with stuff, and it typically works out.
All right, unless you're driving a Formula One race car. For me, I watched Dexter Resurrection. So I've watched all the Dexters except
Was it good?
Yeah, I think it's good. I think the season finale is on this week. So if you haven't watched it, by the way, if you haven't watched this one, but you haven't watched the other ones, don't start here. Like, you got to start 8 seasons ago but it is on Showtime and Paramount. I still can't figure out like what I can just watch with my cable Showtime and which one I have to have. But anyway, I think it's good. I like the original. It's weird. You're rooting for a serial killer, which is a weird thing. But anyway, that was good. Yes, Formula One, NFL football starts this weekend. And all right, that's it. We're done, Shane. We've solved the problems of the world.
Go Pittsburgh Steelers. I can't believe Aaron Rodgers is playing quarterback for the Steelers.
That's a juicy one. That's Steelers.
Look,
Open
man,
up.
diehard Steelers. My father was a big Steelers fan from day one since he was born, right? 70 Steelers, Chuck Noll, the Iron Curtain, or the Steel Curtain, I should say, not the Iron Curtain. This isn't Russia. But I'll throw one more out there. I ordered it. I don't know if you've read it or not. I never mentioned it to you, but The Alchemy of Finance by George Soros. When I ordered your Broken Pie book, I also ordered this, as well as This Time It's Different by Carmen Reinhart, that talks about 8 centuries of financial folly. And I got The End of the World is Just the Beginning. The End of the World is Just the Beginning is essentially a look at mapping the collapse of globalization. So if that's the direction we're headed, it's a pretty interesting read by Peter Zeihan.
I think you can only give like up to 3 books. I think we're done.
I'm giving 12.
I think we're done. They're not going to read all these next week.
I know.
So.
I'm sorry to our listeners.
That's it. We're done. We'll see y'all next week. Take care. Bye.